Politicians pile on the Fed, pressuring the central bank to drastically slash rates. But Wall Street isn't so sure. US Treasury Secretary Scott Bessent made his most explicit call yet for the Fed to execute a cycle of interest rate cuts, suggesting that the central bank's benchmark should be at least 1.5 percentage points lower than it is now. Investors have begun to see the possibility of a jumbo rate cut in September that would be 50 basis points, pouring more fuel on the Fed fire. Toby Gibb is head of investment solutions at Artemis Investment Management. So Toby, another major inflation report as well as key employment data due before the September meeting. Are markets getting ahead of themselves?
I think possibly they are a little bit, Peter. So, we now have a situation where markets are pricing in a greater than 25 basis point cut in September. So effectively 100% certainty of a 25 basis point cut and some probability of a 50 basis point cut. Nothing is 100% certain, but I think a 25 basis point cut seems very, very likely now post some of the recent data points, particularly CPI and the quite weak labour market data that we saw. But I think a 50 basis point cut is probably a little bit extreme at the moment. I think what we're likely to see is the upcoming releases, both on inflation, but also on the labour market, could influence the size of the cut, but are more likely to influence the tone of the press conference afterwards. So, if we see weakness in the labour market, if we see CPI remaining under control, then potentially we see a 25 basis point cut, but with more sort of dovish rhetoric from the Fed governor.
Well, some have argued that the BLS is now compromised after Trump appointed his ally to lead the office. Could the Fed and traders now just see data as noise?
I mean, confidence has certainly taken a hit after Trump's move. So firing the head of the BLS, replacing her with a loyalist with much less experience in statistics, I think is clearly something that the market has not taken well, and rightly so. CPI and labour market data, obviously hugely important data points, not just for the Fed, but for investors more broadly, to get a sense of the pulse of the world's largest economy. But I think what we have to remember is the Fed is mandated to consider the data that comes out of the BLS. So I think what we're likely to see is potentially a change in how the BLS data is weighed. So the Fed and other investors triangulating more with other data points, whether that's JOLTS data or claims data or sort of faster moving data points to triangulate that. I think a couple of things worth noting is one, Antonio is coming in. He's going to be leading the agency, but this is an agency of 2,000 people. They have governance in place. They have very strict controls to make sure that the data can't be manipulated. I think we need to bear that in mind. I think the other thing that we should consider is that there have been question marks over the accuracy of the data from the BLS for some time now, particularly with the number of revisions that we've seen, but also the sort of the fall off in response rates to the survey. So potentially it is a good time to revisit that and potentially try to improve some of the data collection at the agency.
Well, Goldman Sachs sees the Fed cutting 3 more times this year and twice in 2026. Does this match your timeline?
I think possibly we see less cuts in 2025. I think 25 basis points in September I think is looking pretty certain. But I think there is a possibility that we do see more inflation come through in the US from tariffs than we've seen already. So potentially only 2 cuts in 2025, but that will be very much data dependent. I think Goldman's view of the terminal rate of 3 to 3.25 is probably about right, given where the economy is sort of running. But I think what one sort of big caveat to that is obviously Powell's term ends in May of next year, and Trump is very keen to have a new governor that's much more aligned with him in terms of where rates should be. So the jury is somewhat out in terms of what that means for 2026 and rates going forward from there.
Retail sales are due up tomorrow. How will this play into the Fed's thinking, and what are you expecting?
All these data points are going to feed heavily into the Fed's thinking. They have seen conflicting data points over recent months. I think the retail sales will be important. Until recently, the consumer has been pretty strong. Confidence has been pretty strong, and doesn't seem to have been impacted by tariffs. But if we do see signs that consumer confidence is waning, there is a sort of fall in spending due to concerns over tariffs or the rise in unemployment that we've seen, or at least the sort of the weaker labour market stats that we've seen, then I think that could be a key consideration for the Fed.
That was Toby Gibb from Artemis Investment Management. Don't forget, you can watch more videos on Reuters.com.